what are your thoughts on buying deep in the money LEAPS? These are call options, but over a year plus in time frame. So don't let the term LEAP confuse you, but they're just basically long-term call options. But buying them on Tesla and MicroStrategy. In a previous video, when buying a call option, you mentioned the option price ratio staying under 35%. Does this ratio also apply to deep in the money LEAPS? And when would it make more sense to just purchase the stock versus buying these LEAPS? This is a great question. And there is no cut and dry answer to anything in the markets when you involve volatility. We're going to talk about volatility today because this drives the options price, and we're going to dig into this a little bit. So first of all, MicroStrategy implied volatility is 70. That's actually 69 point something. Can't read this. Just call it 70. It's basically 69.44. And this means in any given period, and that's a 30-day implied volatility, it can swing that much. By the way, the implied volatility for Tesla is exactly 43. I think I said Google was 23 or 24. So MicroStrategy is super, super volatile. Not only is Bitcoin volatile, but MicroStrategy swings way more than Bitcoin does. That's why we created the MicroStrategy ARB Cloud, which takes advantage of that. Let's talk about how volatility drives option price. There's a couple of simple things. We have a Black-Scholes model. If anybody wants to see it, let me know. But here you can see I just highlighted in green what volatility is. And the main takeaway from this is it is incredibly important to look at volatility when you look at the option price of a stock. Okay. And this is because the option premium, which is the price you pay for the option, is a percentage of the underlying stock price. Okay. But when you buy a call option that is trading at whatever price, the key is when you have that little green squiggle, the sigma, and when that is high, that drives a ton of pricing action. So the C is the call price equals to that formula. The only thing you need to focus on is the volatility. The higher the volatility, the higher the impact on price. Now, the other X factor is the longer the time to expiration, the more the volatility can play, and therefore the price has to be larger. That's why you typically sell these things. You don't buy them because they're so expensive. Let's look at some illustrations as to why that is. This is MicroStrategy. These are in the money LEAPS out to 2025. And if you look at the price on the left, you will see the strike price. So it'll be 25, whatever that date is, strike price $135, then 140, 145, all the way up to 280. Again, we're talking in the money LEAPS. Now, what I did here is mapped out the actual strike price of the option, the blue, which goes up linearly because they're in $5 increments up until $200. Then we go $10 increments because there's not enough volume to support $5 increments after $200 for this asset. For things like Google, Tesla, yes, there is. The other thing is the ask is the price of the option. That's what people want to sell it for in red. And yellow is the break-even point that I calculated for you. So if you go to the very bottom, you will see if you buy the $280 LEAP today, the asking price is about $120, $130, and you will not make a profit on buying this LEAP until the price of MicroStrategy goes to $405. That's the yellow thing at the bottom. If you buy the $135 call, your break even is $316, which is about $30 above the actual price of the stock today. So yeah, you'll make money on that. But does it make sense to buy that? And per this chart, you will see here, one of them is mispriced. That's what I typically look for when I look at options pricing. I run through the model. You can see here the $155 call is very, very cheap. You can actually break even by buying that under the price today. These anomalies go away pretty fast because people like me buy them up. That's a cheap option to buy. If you had to buy a LEAP, you would typically buy the one that has the lowest break-even point. So I'm pointing to the 337 there, the cheapest option. So that gives you an idea of how these things work. Now, to answer your question, what makes sense to buy? So I did another chart to visualize this, okay? Blue is the intrinsic value of the option. That's how much, If the strike price is $100 and the stock is trading at 280, you're going to be buying at least $180 of intrinsic value. Okay. As the strike price goes higher, the IV goes down up until the break-even point. Second part is the time value. You don't want to spend a lot on time. You sell time. You don't buy it. But if you're buying a leap, there will invariably be some time. And you guys know how I overcome paying for time in the community because I do it all the time. That's my go-to strategy. And finally, the other piece is the important piece here is the yellow, and that means I have it written as margin. Margin means buying the stock on margin. You put half down, you borrow half, okay, versus buying the actual call option. That's the delta between both in yellow. And again, you don't want that to be too high. In a perfect world, the simple way, rule of thumb, is you want IV to equal time value when you buy leaps. But when the volatility is so high, like MicroStrategy, they're too expensive to buy. The simple answer is you buy them on margin. You buy the stock on margin, it's way cheaper. And then on spikes, you sell the calls against it. You sell the time because it's volatile. And that's how you make killer money in the market.